Hello everyone, welcome to Tesla Daily News. Today is July 8th, Tuesday, and the following is the latest Tesla news. According to market data, Tesla stock closed at $402.90, down from the previous close of $419.77, after opening at $416.96 and trading as high as $419.56. Intraday, the low was $401.88, with volume a bit over 38 million shares. Technically, the stock broke recent support with elevated volume and closed near the session low, which can signal short-term selling pressure and caution for momentum traders. That said, Tesla remains richly valued, so investors are watching closely for catalysts from autonomy, energy, and potential corporate actions. According to the investment site The Motley Fool, Tesla's Robotaxi business continues to expand and just launched commercial service in Miami, its first city outside of Texas and California. Tesla began the Robotaxi program in Austin last summer with safety monitors in the vehicles, then gradually started removing them as it gained confidence in its full self-driving stack and fleet supervision systems. The rollout has since extended to multiple markets. Tesla lists Austin, Dallas, and Houston as ramping unsupervised, while operating with safety drivers in the San Francisco Bay Area. The report explains that Miami is a particularly logical test bed. The region has flat roads, favorable year-round weather, and heavy tourist and business travel demand that already relies on ride-hailing. Tesla's new Miami service is starting modestly in a geo-fenced slice of western Miami-Dade County, reportedly between West Miami and Doral, with downtown and Miami Beach not yet included. This limited operational design domain underscores that the rollout remains cautious and controlled, rather than a full citywide deployment. The article also notes that the Robotaxi fleet size is still relatively small. In Austin, the Robotaxi fleet is measured in the dozens of vehicles, and the portion of that fleet operating fully unsupervised is smaller still. Early riders in different markets have reported long wait times and occasional software misbehavior. Availability is restricted to defined service areas within a dedicated Tesla Robotaxi app, emphasizing that this is an early-stage program still focused on safety, data collection, and system refinement. From a financial and stock perspective, The Motley Fool highlights that Tesla's core automotive business is growing but not fast enough to justify its extreme valuation by itself. Over the past 12 months, earnings per share were about $1.10, implying a price-to-earnings multiple above 380 based on recent prices. Revenue grew around the mid-teens year-over-year, but investors are not paying that multiple for mid-teens growth. They are paying for the promise that autonomy and robotaxis will eventually become a large, profitable business. The article points out that Tesla has not yet disclosed detailed robotaxi metrics. There is no public breakdown of robotaxi revenue, ride volume, utilization rates, or per-mile costs. As a result, investors still have to rely on Tesla's high-level narrative and scattered anecdotal data instead of hard financial evidence that robotaxis are already contributing in a meaningful way. The stock's sharp drop after the latest delivery report, followed by a rebound on the Miami news, shows how sensitive sentiment is to any sign that autonomy is moving from vision to reality. The report suggests that for the stock to be fully rescued in the eyes of skeptical investors, Tesla will need to show clear robotaxi monetization and operating leverage, not just map expansion. Many investors will be looking closely at Tesla's July 22 earnings call for more concrete data and guidance on robotaxi economics. According to the Croatian outlet Glas Slovenage and a related English-language report from News AZ, Tesla is seeing a strong rebound in European deliveries and is ramping production at its Gigafactory near Berlin, known as Giga Berlin, to keep pace. In the second quarter, from April through June, Tesla delivered 480,126 vehicles globally, almost a quarter higher than in the same period a year earlier. That follows a softer patch late last year and a more modest mid-single-digit delivery increase in the first quarter, so the new data point suggests a more robust recovery. The Croatian report emphasizes that European demand has been a key driver of this rebound. Data from the industry group ACA show that from January through May, just over 89,000 new Teslas were registered in Europe, representing a roughly 77% increase compared with the same time frame a year earlier. Several factors are credited for this surge: higher fuel prices across Europe, ongoing government incentives for electric vehicles, rapid electrification of corporate and commercial fleets, and, interestingly, a gradual easing of negative sentiment toward Elon Musk among some European consumers and decision-makers. From an operational standpoint, Tesla's production in the second quarter rose a bit over 10% to 451,758 vehicles, actually lagging deliveries. That imbalance helped reduce inventory that had built up in the previous quarter. To support the higher demand, Tesla is stepping up hiring at the Berlin area plant in Grünheide. In April, Tesla announced that the factory would hire about 1,000 new workers by the end of June and aim to lift weekly production by about 20% to around 6,000 vehicles per week. Recently, Tesla revealed a further step. Another 1,000 employees are slated to be added, with planned production rising from October to approximately 7,500 vehicles per week. If achieved, this new weekly rate would translate into a run rate of roughly 390,000 vehicles per year from Giga Berlin alone, making it one of the most significant dedicated electric vehicle plants in Europe. News AZ notes that the expansion reflects smoother factory operations, more resilient supply chains, and continued investment in local European manufacturing capacity. Producing vehicles within Europe shortens delivery times, reduces logistics costs, and provides better responsiveness to regional demand shifts. It also supports a more localized supply chain for batteries and key components, lowering reliance on imports from other Tesla factories. The main product coming out of Giga Berlin is the Model Y, which remains one of Tesla's best-selling models globally and a top electric vehicle in many European countries. Higher output from Berlin should help shorten wait times and stabilize supply across the continent, just as competition intensifies. Traditional automakers like Volkswagen, BMW, Mercedes-Benz, Renault, Hyundai, Kia, and Volvo, along with expanding Chinese electric vehicle makers, are rapidly building out their own electric offerings in Europe. In this crowded environment, efficient and flexible local production becomes essential for Tesla to maintain or grow market share. Glass Slavinage also points out that although Tesla's core automotive business in Europe is delivering healthy volume growth, the company is gradually shifting strategic emphasis toward autonomous driving and artificial intelligence. Management has signaled more than $25 billion of investment into autonomy, AI, and related infrastructure this year, underscoring that long-term value is expected to come from software, robotaxis, and robotics as much as from selling cars. According to the Swiss financial daily Neue Zürcher Zeitung, speculation is intensifying that Elon Musk could eventually merge SpaceX and Tesla into a single mega-company, something akin to an Elon AG that bundles his core ventures, rockets and satellites, electric vehicles, batteries, and high-end AI infrastructure. These rumors have gained momentum in online prediction markets and financial media, particularly after the hugely successful SpaceX initial public offering. SpaceX went public recently in what became the largest IPO in history, raising around $75 billion and briefly putting SpaceX's market value near $3 trillion at its peak. Even after some pullback, SpaceX is still valued at over $2 trillion, making it one of the most valuable publicly listed companies in the United States and globally. In June, SpaceX stock was added to the Nasdaq 100 via a special fast entry rule, reflecting its size and investor interest. The NZZ report notes that Elon Musk and SpaceX President Gwynne Shotwell have previously discussed the strategic synergies between Tesla and SpaceX. Historically, Tesla focused on electric cars and batteries, while SpaceX concentrated on launch services and satellite networks. But the strategic picture is changing. Both companies are now heavily oriented toward artificial intelligence. Tesla is building out supercomputing infrastructure and chip manufacturing to power autonomous driving, Robotaxis, and its Optimus humanoid robot platform. SpaceX, for its part, acquired Musk's AI startup XAI and aims to construct solar-powered AI data centers in Earth orbit, leveraging Starlink and its launch capabilities. The article points out existing collaboration between the companies. An example is the TerraFab, a massive chip and compute manufacturing project that involves both Tesla and SpaceX as they attempt to secure more of the AI value chain. The updated SpaceX prospectus filed before the IPO mentions Tesla 88 times. On page 51, it notes that SpaceX may issue a substantial amount of new stock to finance future transactions, a line that many observers interpret as leaving the door open for a potential takeover or merger involving Tesla. Structurally, such a move would be easier from SpaceX's side. Musk controls a clear voting majority at SpaceX through a dual-class share structure, meaning he can effectively decide on a major acquisition without much resistance. At Tesla, he owns about a fifth of the shares, but over the years he has usually been able to win shareholder votes thanks to supportive institutional investors and a large base of loyal retail investors. Recent votes on his massive compensation package and the relocation of Tesla's legal domicile to Texas demonstrated that most shareholders continue to back his strategic direction. At current market valuations, NZZ explains that SpaceX is actually larger than Tesla, so in a merger it would likely be positioned as the acquirer, potentially offering Tesla shareholders a premium over the prevailing stock price. A combined entity would instantly become one of the top few most valuable companies in the world, with a market capitalization on the order of $3.5 trillion based on recent prices. However, there are significant governance and legal issues. Musk would effectively be negotiating a deal with himself, since he controls both sides, raising intense questions about conflicts of interest and fair exchange ratios between the two companies. Some shareholder groups from either Tesla or SpaceX would likely challenge the terms if they feel disadvantaged. Yet the report notes that because both companies now have their legal headquarters in Texas, minority investors may have fewer avenues to mount successful opposition compared with traditional shareholder-friendly jurisdictions. Texas corporate law generally grants minority shareholders limited rights compared with, for example, Delaware. For Tesla investors, NZZ's discussion frames a potential Tesla-SpaceX merger as both an opportunity and a risk. On the positive side, Tesla stock could benefit from being combined with SpaceX's faster-growing space, satellite, and AI businesses, offering broader diversification and potentially higher growth. The combined company could also enjoy even stronger access to capital and talent. On the risk side, Tesla investors might find themselves assuming more exposure to the capital-intensive, loss-making aspects of space and orbital AI infrastructure, and they would have even less influence over corporate governance in an entity completely dominated by Musk. The market currently treats the merger scenario as a significant but uncertain optional upside. According to a separate note from the Canadian bank RBC, summarized by DPA-AFX and Wall Street Online, this merger speculation is already acting as a potential stock price driver for Tesla. RBC analyst Tom Narayan recently raised his price target on Tesla shares by $25 to $500, while maintaining an outperform rating. He argues that the possibility of a future takeover or merger by SpaceX is a meaningful component of the upside case for Tesla, on top of the existing narrative around autonomy, AI, and energy. Narayan's colleague Ken Herbert initiated coverage of SpaceX stock with an outperform rating and a $225 price target. Herbert describes SpaceX as sitting squarely at the crossroads of two of the most attractive thematic investment areas of this generation, the space economy and artificial intelligence. This alignment, combined with Musk's track record and SpaceX's strong position in launch and satellite connectivity, fuels bullishness on the stock despite its rich valuation and ongoing operating losses. For Tesla shareholders, RBC's stance underlines that part of the current valuation, and any multiple expansion, may hinge not just on Tesla's standalone fundamentals, but on corporate action optionality. The idea is that if SpaceX ultimately uses its high-value equity to acquire Tesla, Tesla investors could be bought out at a premium or find themselves holding shares in an even more ambitious combined enterprise. However, investors should also recognize the flip side. If such a merger fails to materialize, some of that speculative premium could unwind. According to the Canadian public broadcaster CBC, authorities in British Columbia are investigating a viral video that appears to show a Tesla driver asleep at the wheel on a busy stretch of the Trans-Canada Highway between Golden and Revelstoke. The video, shot by another motorist, seems to show a woman in a gray Tesla with her eyes closed, hands off the steering wheel, while the car continues driving. The witness claims there were two children in the back seat, though local RCMP have not confirmed this detail. CBC quotes Fred Lambert, editor-in-chief of the electric transportation site Electrek, explaining that Tesla's driver assistance system includes multiple safeguards. According to the Tesla owner's manual, every time an automation feature is activated, the car displays a warning reminding the driver to stay attentive and keep their hands on the wheel. A cabin camera above the rearview mirror tracks the driver's eyes, and the system regularly nags drivers to apply torque to the steering wheel if they appear distracted. However, Lambert also notes that some drivers deliberately circumvent these safety mechanisms. Techniques include wearing certain types of polarized sunglasses that can interfere with eye tracking, or attaching so-called nag defeat devices to the steering wheel to simulate constant torque. He points out that in the video the driver appears to be wearing sunglasses and may have a steering wheel accessory that could potentially help defeat monitoring. Lambert warns that as self-driving and driver assist technology grows more capable, some drivers are becoming overconfident and complacent. While Tesla's data indicate fewer critical incidents per mile when its systems are used properly, he cites statistics suggesting there can still be a critical incident every several thousand miles, whereas careful human drivers can often drive hundreds of thousands of miles without an accident. This underscores that Tesla's current systems are driver assistance only, not full autonomy. CBC further explains that under British Columbia law, and according to the Society of Automotive Engineers levels of automation, Tesla's current systems are considered level 1 or 2 driver assistance. These features can provide lane keeping, adaptive cruise control, and automatic emergency braking, but they still require a fully attentive human driver. Provincial amendments to the Motor Vehicle Act that took effect in April of last year prohibit operation of vehicles with level 3 or higher automation that would not require a human driver. A local highway patrol spokesperson stresses that in British Columbia, drivers must remain alert, sober, focused, and have at least one hand on the wheel at all times. It is not legal to rely on full self-driving or treat the car as a robot chauffeur. Legal experts quoted in the report suggest that the Tesla driver in the video could face anything from traffic tickets to criminal charges for dangerous operation of a motor vehicle, and possibly negligence charges if children were indeed present and placed at risk. For Tesla enthusiasts and investors, this incident highlights ongoing public and regulatory scrutiny around how drivers use Tesla's advanced driver assistance systems. Misuse can lead to negative headlines, legal crackdowns, and potential restrictions on future deployments, all of which matter as Tesla tries to convince regulators and the public that its technology is ready for broader robotaxi operations. According to Turkish outlet Haber 7, Tesla has raised prices at its Supercharger fast charging network in Türkiye for the second time in roughly 2 months, increasing charging costs for both Tesla owners and drivers of other electric vehicle brands who use the network. The newly updated tariff sets the price for Tesla vehicles at 10.40 Turkish lira per kilowatt-hour, up from 9.90 lira previously. That represents a bit over a 5% increase in charging costs. For non-Tesla electric vehicles that charge at Tesla superchargers in Türkiye, the rate has risen from 12.30 lira per kilowatt-hour to 13.00 lira, an increase of nearly 6%. These adjustments come in a competitive environment among licensed charging network operators overseen by the Energy Market Regulatory Authority, known as EPDK. The report notes that rising energy and infrastructure costs are putting pressure on operators, which in turn flows through to higher end-user prices. For Tesla owners in Türkiye, these back-to-back price hikes mean that total cost of ownership is rising somewhat faster than expected, especially for high-mileage drivers who rely heavily on superchargers. For investors, the move illustrates Tesla's global strategy of adjusting supercharger pricing to reflect local energy markets and inflation, while also trying to maintain reasonable profitability in its charging business. The ability to pass on cost increases without sharply suppressing demand is important if Tesla wants its energy and charging segments to become significant profit contributors over time. According to Czech outlet Metro, Tesla Energy Group, which is a European energy technology company distinct from Tesla, Inc. in the United States but sharing a historical name, has built the second-largest battery storage facility in the Czech Republic. The installation, located in Velká Bystrica, has a power rating of 10 megawatts and an energy capacity of 27 megawatt-hours. While this project is not directly owned by the California-based Tesla, the news underlines the growing importance of large-scale battery storage in the European energy landscape, a trend that aligns with Tesla's broader energy storage ambitions. The Velká Bystrica facility is designed for precise power output control and extremely fast response, allowing it to help stabilize the electric grid by responding instantly to frequency and voltage fluctuations. The complex consists of 6 Li-FePO4 battery containers grouped into 3 power blocks, each with 2 battery containers and 1 inverter. The system uses liquid cooling to maintain safe and stable temperatures, improving efficiency and extending battery life, and the containers are insulated for additional thermal stability. Cybersecurity and operational resilience are emphasized. The project relies on a local control unit architecture that minimizes the risk of unauthorized external access while still enabling secure communication with higher-level grid management systems. The storage facility is connected to Tesla Energy Group's dispatch center, which continuously monitors metrics such as temperature, pressure, and performance. If a fault occurs, technicians can be dispatched rapidly due to the company's local service presence. For investors in Tesla, the key takeaway is that utility-scale battery storage is becoming a mainstream part of European grid infrastructure rather than a niche technology. Tesla's own Megapack and grid-scale energy businesses could benefit from similar demand trends worldwide. As more grids adopt large battery systems to balance intermittent renewable generation and support peak demand, the addressable market for Tesla's energy products should expand. According to financial site Finanzen.net and reporting from DPA-AFX, SpaceX's rapid index inclusion continues to underscore its prominence in the public markets. After its record-breaking IPO in mid-June, SpaceX has already been added to the Nasdaq 100 index. The Nasdaq used a special fast entry rule tailored to allow SpaceX into the index only 15 trading days after its first listing. At its peak shortly after listing, SpaceX shares climbed to almost $226, giving the company a market capitalization of nearly $3 trillion and briefly ranking it as the fourth most valuable company in the world. The stock has pulled back but still trades well above its $135 IPO price, currently around the mid-160s, implying a valuation a bit above $2 trillion. This makes SpaceX the sixth most valuable company in the United States at the moment. The report emphasizes that index inclusion has important implications for trading dynamics. Exchange-traded funds and mutual funds that track the Nasdaq 100 must now buy and hold SpaceX shares, which supports liquidity and can influence price behavior. The S&P index provider has not yet adopted similar fast entry rules, so SpaceX will not join the S&P 500 until at least a year has passed and it meets the usual criteria. Entry into the Dow Jones Industrial Average is considered even further off, in part because Dow selection also weighs qualitative factors like corporate reputation. While this news centers on SpaceX rather than Tesla directly, it reinforces the immense financial firepower Musk now has via his various holdings. If SpaceX equity retains a high valuation and deep liquidity, it could be used as an acquisition currency in any future Tesla merger scenario, something equity analysts like those at RBC are already factoring into their strategic frameworks. According to the Swiss NZZ article, as well as coverage from the Motley Fool, another layer of the investment debate is whether SpaceX stock is already overhyped at current levels. One Fool analysis calculates that based on roughly $18.7 billion in revenue in the previous year, SpaceX's valuation equates to a price-to-sales ratio above 100 times. This is substantially higher than many other high-growth technology companies, even ones with strong AI or cloud profiles. The piece argues that while SpaceX runs multiple promising businesses core launch, Starlink global internet, and advanced AI infrastructure through XI, investors should be mindful that it is still operating at a loss and that many of its boldest initiatives, such as orbital data centers and mainstream human spaceflight, are very long-term in nature. The author suggests that for current shareholders, a long-term holding stance may be rational given the quality and ambition of the business, but for new investors, patience and selectivity might be warranted. For Tesla holders, this analysis provides context. If SpaceX's valuation were to compress from these lofty levels, that could reduce the attractiveness or feasibility of using SpaceX stock to acquire Tesla at a large premium. According to Haber 7 and other regional energy news sources, rising charging prices, deepening European energy storage infrastructure, and increasingly robust European EV sales all contribute to a broader macro backdrop that matters for Tesla's multi-segment strategy. On the one hand, higher energy and charging costs can raise operating expenses for EV owners and fleets, potentially affecting demand elasticity. On the other hand, they also increase the economic value of efficient vehicles, home and grid-scale storage, and solar plus battery systems, areas where Tesla aims to play a central role. As Tesla investors weigh today's share price volatility, they are effectively betting on a complex mix of variables: the pace at which Giga Berlin and other factories can scale efficiently, regulatory acceptance and public trust in Tesla's autonomous driving and robotaxi services, Musk's ability to manage multiple giant enterprises, including a now public SpaceX, without overextending, and the possibility still speculative but increasingly discussed of a future Tesla-SpaceX mega merger. That's all for today's episode of Tesla Daily News. Thank you for listening, and if you enjoyed this show, please subscribe and share it with other Tesla enthusiasts and investors.